So my name is Chris. As Donna mentioned, it's Chris Bettis. Y'all are group number 3. So we did a session at 8 and then one at 9:30. The 8 o'clock group so far has asked the most questions, but y'all look like a good inquisitive group, so we'll see. The goal is that it is informative. So I hope that you will ask questions. And I'll answer everything that I can. If it's something that I can, I'll tell you, and we'll work to find the answer if need be. Let me start by telling you a little bit about First Citizens, our role with the retirement plan. Donna kind of alluded to it a little bit. So we work as the trustee and the investment fiduciary on the plan. So I meet regularly with the retirement plan committee, with Donna, Sherry Sowers, and folks to review the plan kind of top down. So that can be everything from the design of the plan to the structure to all of those things. And then also the investment options. We regularly screen, score, and review those. So from time to time, we make changes. You all have seen announcements when a fund has been replaced, either the fund itself or perhaps where we could offer a less expensive shared class version of that same mutual fund. So we have regular due diligence meetings to make sure the plan is the best it could possibly be. The other part of my job, which is kind of my favorite part, is doing stuff like this. It's interacting with you all, doing participant education. Because in my mind, a retirement plan can be great. The company could offer the best benefit ever, but if no one is utilizing it, then it's not really successful. So the goal today is to give you some information to think about. Hopefully you'll ask some questions. And also to make sure you know you've got my business card and the folders, those, so if today doesn't work, maybe you're shy, don't ask a question in front of the group, or just want to schedule a time to talk one-on-one, we can do that at any time. We want you to know that there are resources for you to be able to ask questions when you have them. There's resources either through me, there's an 800 number and a website. You can contact lots of different ways to get information about the plan. You all have a packet in front of you. I just want to make sure everybody's got each of these pieces that we're going to cover. You should on the left-hand side see a couple of these. You all know that packets in? We've got a couple more. You should have a piece on the left-hand side that's got some pictures on it. And then on the right-hand side, you should see a top 10 retirement plans piece. You should also find a sheet in the back of that that's got the website and the 800 number for how you access your account information. One side of that page has got the website. You can go to firstcitizens.com. It gives you instructions for doing that. And then there's the 800 number on the other side. You can call that team between 8 to 8 Monday through Friday, get a person on the phone to ask questions if you need to, or if you need to reset your account access, something like that, those folks can do that. You're calling people that are based in the U.S., so you'll understand them on the phone. They'll be nice and helpful to you. If there's ever a question that is kind of outside of their purview, they're going to refer you to me, and I'll know to call you to help with anything. You know, some of the kind of questions might be, hey, I want to transfer money between certain accounts. You can do that at any time, either on the web, the 800 number. But if you have more questions about doing that, that group will help. So we're going to go through each of those pieces. We're eventually going to get to this. We'll use the screen for it. And we'll also try to go to a website to give you a couple of visuals on things as well. But I do hope you'll speak up and ask questions if you have them. It helps me as a speaker. Lets me know that I'm doing a good job if I'm actually speaking to things that are of interest or on your mind. If I'm not, that's a bad sign. That's when you definitely want to ask the question, because the goal, for me, I try to come prepared with information that I think will be valuable for you. But I'm not a mind reader, and I don't know what everybody is thinking. So if you've got the question, ask it. Chances are, if you're thinking about it, somebody else is too. So you're helping yourself and them. Yes, ma'am?
Before you start, do you have 3 more packets?
We've got some. We have run out of folders, but we've got the information, and we're going to have more too. I'm going to send an entire other supply as well, so that everybody has this information. So as Donna mentioned, and as Emily is handing that out, this is an opportunity right now for you to make changes to your contribution amount. So the plan allows you to make changes to how much you contribute to the plan quarterly. So in the plan, you get a match, an employer contribution if you contribute money. And they'll match up to 6%. You're contributing 6%, they provide a match towards that amount. Any money above that is not matched, but you're you're still saving towards retirement. The single most impactful thing we can do as individuals, and I say we because both Emily and I participate in 401k plans as well, so this applies to all of us, is increase the amount that we put into the plan. A lot of you may have come into the plan automatically enrolled, default enrolled, if you come in the last few years, so you may be contributing 3%. If you were to take and move that from just 3 to 4, or from 3 to 5 or 6, a couple of dollars on the front end has a huge impact on what you ultimately have in retirement. Through compound interest, a couple things we'll look at in a little bit more detail. Let me give you a kind of a simple example of how that works. If I make $100 in a pay period, and right now I'm putting in 3%, how much am I contributing? $3, right? So if I increase that by 1%, I'm taking it from 3 to 4. If I said, hey, this makes sense, I'm going to move it to 6, I'm taking it from 3 to $6. I'm going to show you a visual in a little bit too with some examples of the dollar impact in a paycheck. Because sometimes people get hung up on how much is it going to affect their net check or what they're contributing to the plan. So we'll look at that. So you can do your contribution, you can make a change for July 1, as Donna mentioned, and put it into payroll. We've had folks in each session so far, I've had to make extra copies of these forms after each meeting, which is a great sign, because I know this is all that I talk to people about. The more that you can put in on the front end, the more successful you'll be on getting that savings amount that you want to get to. We'll talk a little bit about what the goal and what the right amount may be. Now, with that said too, it's your money. I get that, so I'm not here to lecture you. If you don't want to participate in the plan, if you don't want to increase, by all means, you do not have to. But I want to give you information so you can make a good, informed decision to ultimately help you have choice when you get to retirement age or what you may or may not want to do. So in this plan, when we contribute, there are 2 different ways that we can do it. You can do it through a pre-tax, tax-deferred contribution, or you can do Roth after tax. It's great that this plan allows you to choose either one or both. So pre-tax in my example where I make $100, if I put $6 in, Uncle Sam taxes me on $94. That $6 I put in gets invested, the interest that it earns is tax-free growth until I take it out, then I'll pay taxes at that time. Roth is the exact opposite. I make that $100, I pay tax on the 100, then I put the $6 in. When I take it out, as long as it's been in more than 5 years and I'm over age 59 and a half when I do it, it's a tax-free withdrawal. You can do it all tax deferred, all Roth, or a combination of the 2. The dollar amount maximum this year you can contribute to a 401k is $19,000, or if you're over 50, you can do an additional $6,000 in a catch-up contribution. It's a lot of money. Most people I talk to are not maxing out contributions, but I do often get that question. So that limit can change year to year. It was $18,000 and $18,500 for a while. So we have pre-tax or tax deferred. The impact of paycheck is different, right? The pre-tax, if I'm putting in that $6 and I'm only taxed on $94, my net paycheck is not going to go down by $6, right? Because I've lowered what Uncle Sam looks at for taxes. It might go down by $4. In Roth, it's a dollar for dollar impact, because I'm paying the taxes on it, putting it in. Don't ever get hung up on which contribution type is right. If you have questions about it, we can certainly talk about it. It's just the impact it's pay now or pay later for taxes, whichever way feels right for you. No matter how you contribute, you're going to get the company contribution going in and those things. Any questions about that? So in the booklet, if you'll pull out the piece, it's got First Citizens brand on it. Can you give me a copy of that? Right there. So this one is actually a PDF, so we're going to look at it kind of in a visual before we go to our PowerPoint. And I'm going to mention a few concepts for you. So it looks like this. Yours is going to be up and down, a little bit different color. It's got some circles on the front. It says retirement, your retirement income strategy, and it's got the First Citizens brand right there. Everybody see that? So this is a great piece to spend a few minutes kind of reading and going through. The information I give you is very high level, but there's some good concepts to think about. So I'm going to talk through that stuff, but my hope is that you might spend 10 or 15 minutes on a lunch break or this evening looking this over as well. just to trigger things in your mind around savings. So the beginning of this piece, it's really talking about the ways that we save in our country today. So I'm from Winston-Salem, and my grandparents and people of that generation worked for R.J. Reynolds Tobacco. It was the biggest employer in town. And they had a pension plan. And you guys have heard of those probably before, the defined benefit plan, where they got a paycheck from the company in retirement. Pension plans have largely gone away. What they've been replaced with are 401k plans. So a pension plan was called a defined benefit plan because they told you how much you would get in retirement in the check. A 401k plan is a defined contribution plan. You choose and define how much you put in with market performance and those things that generates the income, the amount of money you have at retirement. So that's the difference between the two. But today, most of us have the ability to contribute to a 401k plan, and then there's Social Security that fits into part of that. Social Security, you've got another piece that's got these colors on the front, and it looks like this. If you flip to this page, it's got the two big pictures on it. You'll see 80%, and then there's 34 and 66%. Social Security is designed to cover about 30 to 35% of what we need to live on in retirement. So that's an income source. The rest of it we choose to contribute to on our own, either through a company-sponsored plan, or if we have investments or savings or anything like that, getting towards the amount of money that we need to live on in retirement. This 80% that you see over here, this relates to how much money we should be targeting to have, the source of income that we're going to draw off of. So what that's saying is, if you think about what you make now, most people need $8 for every 10 today in retirement to live on. You may not need 100% because maybe your bills and things are lower, so that's what you're shooting for. Social Security is covering about 30% of that. The rest we need to come up with as individuals. Now that 80% is a general number. Some people are going to live more lavishly in retirement, maybe travel, do lots of things. Other people are going to slow down and really not do as much, so it might be lower. But that's a good sort of general barometer to think about in terms of a target for income. I got the question earlier today, and I get it very often, well, how much should we be saving? So what's the dollar amount? Is it 100,000? Is it 500,000? The answer is that it's different for every one of us. It's based on your goals and objectives to retirement as to how much you want to have to live off of in income. So it's not the pot of gold at the end of the rainbow, it's the pot of income that's going to generate money. And we're going to see in some slides and things, we're living a long time in retirement age. So we need the money not only to get there, but also to last as we go through. And the average is around 20 years today that a couple age 65 lives in retirement for a long time. So we accumulate money on the way, and then we also continue to have it invested, even in that phase where we're distributing, taking it out, so that it continues to earn and grow over that time, so we don't outlive it. Any questions kind of around the basics of the savings, Social Security, how that fits in? You've got a couple of projections at the bottom that show a salary and how much, based on years to retirement, money we target to try to save. The next page, as you flip over to that, it says benefits for today and tomorrow. We plan on those three primary benefits. The first one, and what I think is probably the most important, is it's convenient. It's easy. If you all are in the plan right now, you probably don't even notice or think about too much that 401k contribution coming out every pay period. You've got it going in, we get going with our lives, we're just accustomed to it. It's easy. This is not like you got to go up to the First Citizens branch and take them a check every Friday. It happens automatically. The advantage to us all as investors is when you do that, you do something called dollar cost averaging. It means that you're buying in as the market moves up and down. This Friday, the market might be up. Next Friday, it might be down. That blended rate of return, a blended rate of buying shares, you're going to have a lower cost per share than somebody that tries to time the market and buy in just one day. So it's easy. Out of sight, out of mind. You start contributing, and then really the only things that you as an individual need to think about with the plan are, at times, can I contribute more money? And you can do that quarterly. Again, we've got that form for you. And also, am I invested appropriately based on my life and career phase and risk tolerance? We'll talk about the investments in just a minute, but the convenience is there. I talked a little bit about the tax advantages, the pre-tax and the Roth. Great options to have. And remember, if you're doing one or the other now, and you want to change and go in either direction or combination of the two, you can do that. It's simply letting your HR folks, your payroll people know the amount you want to contribute and how you want it done. So some projections there for you as well on money type. If you flip over to the next page, I'm going to talk briefly about investment options. So in this plan, you've got a list of mutual funds. You have individual mutual funds, and then you have Vanguard target date investment options that you can utilize. The individual mutual funds are kind of for folks that are do-it-yourselfers, that are into investments, that want to pick and choose their funds. The target date funds are allocation funds that are built that hold lots of different things in them and move through life and career phase automatically. So the younger you are out, you might invest in the 2050 fund, meaning 2050 being the year when you be retirement age. So that fund today is very aggressively invested. The closer it gets to that date, more conservatively invested. If I'm closer to retirement, maybe I'm in a 2025 fund, it's going to be more conservative today. It's going to hold more bonds than stocks relative to percentages. It automatically adjusts. If you look at the sheet here, you've got three bubbles. I described for you there literally a little bit what a stock is. A stock is ownership in a company. If I own a share of IBM, I own one little piece of ownership of that huge company. Bonds are debt. So I may own a treasury bill, which is where I've loaned money to the U.S. government. I could own a Virginia state bond. I could own a municipal bond or a company bond. They're promising to pay an interest rate off of that. Stocks, as we'll see in a minute, have performed higher than bonds, but there's also potential volatility there, so you have to balance that out. Also in this plan, there is a stable value fund, a cash option. So you could put a portion, some of your money in there as well. The one caveat or caution with using the stable value fund is the rate of return on those type of accounts. So they're averaging probably 1.5% return. Now, they don't go down, but they also don't have the upside potential that the stocks and bonds do. So let's talk a little bit about inflation, and I'll show you some examples. You've got a couple of visuals of that, some pictures related to that. Inflation is how much things cost and how it grows over time. So inflation historically in our country has averaged about 3%. So if you look on this page that says, why save now? You can see in a 10-year period, the cost of a dozen eggs going up from 95 cents to $1.50. One of the examples I always use is the price of a movie ticket. When I was a kid in Winston-Salem, I could go to the movies for a couple dollars, something like that. Now I have two kids, and I usually don't take them to the movies because of how much it is. I did take them recently to see that Marvel movie, Captain Marvel, which I wasn't really excited about going to, but it was pretty entertaining. I actually enjoyed it, although it was like 3 hours long. But we had a gift certificate that somebody had given us, so I didn't have to pay the $40 or $50 that it would cost for the tickets and the popcorn. That is something that we're all fighting. That's a headwind, right? We can't do anything about it. So if inflation is averaging 3, and I had all my money in a cash account earning 1.5%, what's happening? It's not keeping up with that. So the purchasing power is actually eroding. So when I go to take that money out, it's not going to buy what it does today when I put it in. So I always try to work with people that might be on the conservative side and push them into the water a little bit, taking on some risk for upside. The opposite of the coin would be somebody that was super aggressive and want to put all their eggs in one basket, like in one stock or one really aggressive mutual fund. You don't want to do that either. So we try to kind of pull them in from the deep end of the water a little bit. So you have balance, and then kind of the investment term is asset allocation. You diversify in different areas. In our plan, again, the target date funds do that for you automatically, or you can pick and choose on your own the fund in percentages to how it's invested. Either way, you still want to monitor over time to just check in on things and make sure it's right for you based on life and career phases. Any questions with stocks, bonds, inflation? You guys are being quiet. So moving forward, I'm going to give you a visual now on stock performance. The next page for you, it looks like this. It's got some charts on it. It says Investing 101 at the top. It's going to show you what the value of $1 over the last 20 years has done in terms of growth. So small cap stocks, which are aggressive, but they've had a return of about 8.9% over that time. You can see cash and inflation down at 2% at the bottom. Again, the goal is to outpace that 2 to 3%, so stocks help us get there. If you look at the S&P 500, you guys hear that quoted on the news all the time, right? That's the largest 500 companies on the U.S. stock market. That's an index. It looks at those companies, how they performed over time. If you go back to the 30s until today, the S&P 500 has returned around 10.2% over that entire time period. Now, there's been times where the market has gone up and down. So when we think about the 401k plan, it goes back to when I mentioned convenience. You're automatically putting in, you're getting out of your own way, so you're not worried about what the headlines are and whether the market is up or down. You're buying in at different rates. If you let that stretch out over time, it will grow to the balance that you want. Being consistent with it over time. This is a visual for you on stocks versus bonds and cash. And then also, there's some other little examples of inflation at the bottom of that page for you. The next sections of this piece are really some kind of goal planning tools and a couple of worksheets. People spend more time planning what they're going to have for dinner or their next family event than they do thinking about this stuff. There's nothing wrong with that, it's the reality, but part of my challenge to folks is to spend a few minutes going through this information. So you've got a couple of worksheets and things where you could work through savings goals, time horizons, and those things. There's a 12-question sheet that you can tally up and score. There's also a risk quiz in here for you to look at. One of the most powerful concepts in investing and in retirement plans in general is compound interest. You can see that in one of the pages back behind the first worksheet. Albert Einstein called it the most powerful force in the universe. So compound interest, you ever had a savings account as a kid, which I did, I mowed lawns, and I'd get 10, 12 bucks a month, something like that. I put it in the bank would pay me $1 or $2 in interest. So let's say I had $2 in interest. The next time I went to put money in, it was on 14 instead of 12. Same concept works in here. The stocks and bonds perform, they gain in value. The dollars you put in, if you picture kind of a pyramid in your mind, that base becomes, the stack becomes higher and higher and higher. So the compound interest works really well. I'm going to show you visually in just a second a couple examples of that. But that goes back to my challenge of saying, hey, if you're at 3% now, think about moving it to 4. A lot of people would think, well, that's not but a couple of dollars. You know, is that even worth it? It absolutely is. It moves the needle in ways that we don't think of until you see a visual of it. Very powerful way to do it. My hope is that you take full advantage of the plan with these things. But this is a great piece to look at. Let's see if we can. We'll go to this website now. Emily's going to help me with this. I'm standing over here, so I'm staying in the video screen. So she's going to play Man White for me. This is a website. I want to give you the web address because it's just a public website. If you choose to look at it later, it is the letters JH and then eTools, TOLLS.com. It's a website actually created by a company called John Hancock. It's just a public website, but they got a couple of great calculators that I want to show you a visual for you. So if you'll go to, let's do the compound earnings calculator first. Did everybody get that site? JHETools.com. So I'm going to talk through, hopefully everybody can see it, but what this does is let us project. So let's assume the first question is how much have you saved so far? You'll put $20,000 in there. Okay? And then the next is how much do you want to contribute per month? Let's put $100. $100 a month. Next is the interest rate. It's at 5. I'm going to leave it there. We know that inflation is averaged around how much? 3. A couple people are listening. Good. We're going to leave it at 5, which is a very conservative assumption. And then we're going to put the years. So we're going to assume that somebody's like 45, so let's give them 20 years. And then if you'll put that calculate button, it's going to show and project out a balance over time. So this is a great way for you to get a visual on what money can grow to. The total deposits the person put in was $44,000 over that time. The interest is larger than the money put in, $51,000. Final balance at $95,362. Now let's make some adjustments and see what happens. Anyway, let's take that 100 and make it 150. Thank you. And then we'll leave the others the same for now, just with calculator. Now 115, right? $10,000 plus adjustment just from that $50 a month. I think you guys get paid twice a month or bi-weekly, right? That adjustment has a significant impact in that number. Now let's take that interest rate that's at 5 and move it to 8 and hit calculate on that. 186. So the interest rate plays a huge key in it. So I would not use an assumption any higher than around 8 because I would never want to mislead somebody in return. I wouldn't even show the 10% number, even though I know that's historically what the stock market, the S&P has done. Partly that's because I'd rather you see something that's a lower bar and have good news rather than trying to overshoot it. Use things that are accurate so it's a pleasant surprise later. But this is a great way for you to be able to come in at any time, plug in how much you saved, how much you've saved so far, how much you contribute now, and maybe what you would adjust to, and project out over time. Move it to 30 years, please. That took it to 442. So the real power is the younger you are, and you turn it on because of that time. But wherever you are in life and career, it works. If you have a shorter time frame, that's fine. But the younger you are, the more you can do on the front end, the more it projects out. Let's now go to that other calculator. You should be able to go just to the eTools tab up here.
This is on that website you just had?
Yes, ma'am. Click right there. Yeah, when you go into the site, it's going to list these things. There are two we're looking at, that compound earnings calculator, and now let's look at the contribution calculator. So there's a lot going on this page, but what I'm going to focus on is we're going to put the information in on the left, and then I'm going to show you that it projects out and lets you see by dollar and percentage the impact to your paycheck. So if you are struggling and you might say, hey, that makes sense, you know, Chris was right, I want to increase my contribution rate, but I want to see what it does to my check. So for birthday, let's just put it somebody whose birthday is today, so we're going to use June 12th, and we'll make them 45, so go to 74. And then Virginia, first state of residence. There we go. And we'll put their salary for this example at $30,000. And payroll we know is biweekly. And let's put $25,000 as current savings. So based on that, focus right here, and if you will, put a 3 right there. There you go. I got it. So 3% of $30,000 is $900 a year contributed. You save $142 in taxes, it lowers your paycheck by $29, but click the dollar bill for me, please. I put in 29, I contributed 35, it only lowered my check by 29. So that's an example of that tax deferred savings. Now let's go and instead of at the 3%, we'll make it 6%. So that's lowered my paycheck by $58. I'm putting in $1,800. I've doubled the contribution amount. What this doesn't factor in is the employer match as well that's contributed. So this is kind of a low bar to ultimately what you would have in terms of contributions. If you click on the dollar, you know, $69 a pay period. It's a great way for you to really visualize the numbers. Because that's probably the most common question I get from folks is, hey, I want to do this, but I'm not sure how it's going to impact the check. So you can get a feel for it. Now, you also, if you're in the plan and you ever needed to stop contributing for a while, you can do that. And as I mentioned, you can change the amount quarterly. But this is a nice tool. It's just out there. It's just a website that I'm aware of, and I like it again because it's easy to plug in information. So use it if you choose to, may help you get comfortable with your contribution rate. Any questions? I'm gonna have to start asking questions.
What, all right, I've got
Yes.
one. What is right now, what is a good return percentage?
I'm sorry.
What is a good return percentage? You were using 3%, you were even up to 8%. I mean,
Well, for the stock market in the short term this year, most folks, if you looked at the return in your account, if you're in like one of the target date funds, you're probably at 10, 11%. Stock market's done really well. The reason I use like 5 or 8 is to give you a longer term view of closer to what an average return would be. The low bar would be outpacing inflation, so 3% or more. There are years where the stock market will be down. Last year is an example of that. Anybody look at their 12/31 statement and see a negative number? Stock market was down. And we've been kind of lulled to sleep how it had gone up for several years, and then it went like this. But this year's come right back up. So you want to, it's hard when you see in a period where there's a negative return, but you haven't lost anything until you cash in that money. Sometimes people will react emotionally to a period, a short window of time where the market's gone down, and they end up selling at the bottom, which we don't want to do. Now, I understand, I get it, why people look at that, and it might make you nervous or something, but if you recognize that the longer you leave the money in the market, the better off you'll be, because they do have market events. Things like December happened, and that was pretty steep, but it happens. A couple of years ago, and it's still in the news now, y'all have heard of this thing, Brexit, where they voted to leave the European Union. Well, when that vote happened, the entire world freaked out. The stock market, it was like late June, early July time, a couple of years ago. Stock market went way down for like 2 days. By the next week, it was back up. But there were people that reacted emotionally that time and sold out. And if you do that, you cannot get that money back. It's just like the time of not contributing. We saw the example of earlier you could do it and be consistent with it. Use that to your advantage. And we're not going to time the market. None of us can do that. If we could, we wouldn't be here, right? We'd be somewhere else, living on all this money. So what we can do, what you want to do, is control what you need. As investors, we can control how much money we're putting in and the investment options that we choose that are appropriate for our U.S. dollars. But I can't choose what's going on politically in the world, right, today, or who we're fighting with about tariffs or any of those things. But that stuff has always happened, right? Think back historically. We've been in a fight with somebody about something pretty much the entire time the country's been around. There is always noise. The difference today that's hard for a lot of us is we get the information quicker than we ever have because we all carry these things. And so it's coming at us, so we could have a tendency to react emotionally to something that might be a short-term market event, but by the time we've heard about it, if something's going to happen to the market, it's already happened. So what we can control is being consistent with our contributions, and then when we get closer to retirement age, getting engaged and making sure that we're allocated appropriately so that perhaps we've got less risk, more bonds that don't react in the same way that stocks do to market events, more conservative to how we draw that money. Other questions? Yes, sir.
Is there a website or is there a portion of this website where you could calculate in maybe money you have in other areas? So if it's not just your 401k savings with Davenport Energy, let's say you worked at another job for a good number of years and transfer or roll that over into a separate IRA that you may or may not be contributing much to. Is there a way to factor that in?
Absolutely. So you could just put it into this current savings
So
box
that
here.
Okay.
Yeah, so this is not tied specifically to the 401k plan. So if you had, you could make that number 100,000, whatever you wanted to. You also can do that within the website for the plan. When you go into your individual website, there's some tools there, and it will ask you any inside savings. It's a great point, because if you've got money in other places, factor that in, because really what you want to be doing is looking at your entire picture. And most softwares, most companies in financial services are creating these aggregator tools where they're wanting to show you that. The reason is people are getting older, and as we retire, that money is sort of in play for different financial institutions that want you to work with them. So they're going to show you those things so you can get a visual on your entire picture. The advantage for all of us is you could go to any number of websites and find tools where you can plug that information in. There's a couple of great ones through Social Security. We'll talk about that in a minute too, but in the AARP has some good calculators. They'll all ask for total savings and those things so that you can calculate and put that in. For some people, if you have money in other places, that might drive your behavior a little differently in how you invest in this plan. If you have a substantial amount of money in an IRA, and perhaps that money is pretty conservatively invested, you might decide to have this portion be more aggressive or more conservative. There are different ways, so it's all individually based on your situation as to how you go about that.
Do you have a recommendation as to how you should invest those, whether they should be something, if you've got several years left to go, and by several, I mean, 30 years,
In terms
35
of
years.
an IRA versus a 401k,
Yeah, I mean,
bringing money
would
together.
you recommend doing one more conservative, or if you're young enough, or you've got enough years, do you think it's best to just high risk, high reward and every?
I would tell you the younger you are, the better off you're going high risk, high reward, because you've got that time. And if we study it from a historical perspective, you will win in the end with that. Part of that, though, has to come back to how you're wired individually, because you need to be comfortable with it. There are some people that just wake up in the morning and are real nervous about the stock market, and that's okay. That's fine. There are other people that would be super aggressive, so you want to caveat that a little bit. And then in terms of those situations when you've got IRAs and other things, you want to evaluate how that's invested. You want to look at what the costs are you're paying to have those funds managed versus the 401k. Because the one absolute that I know here is you're getting a company contribution, a match, plus you're putting money into this plan, and you may not be putting money into that IRA. So just thinking that through, and what we saw with compound interest, the more money I can have into one place where it's working as hard as possible can be a real advantage. But you may have an IRA with an investment that's unique to this plan or a very strong reason for keeping it there. But you want to evaluate those things. For some people, consolidation makes a lot of sense. For others, not. It's individual, but you want to, if you look at that stuff, it kind of goes back to my comment of making an informed decision about it. But in general terms, somebody younger should take on more risk because they have time. And as we get older, we become more conservative for our nature.
Now, I have a question. Because you take, as companies, Davenport for schemas, and a lot of people don't allocate what they want their funds to do. How do you allocate it if nobody does anything personally? Do you a mixture of stocks and bonds?
If somebody doesn't choose their investment election on their own, they go into one of the Vanguard target date funds based on their age. And it does hold a mixture of stocks and bonds relative to how many years they have to retire. So if I'm 25 and I haven't chosen investments, but I have money going in, it's going to be in a Vanguard like 2065 fund because I've got about 40 years to retire. If I'm much closer to that date, it would be in one more for the year like 2025. That's called a default fund in the plan, and the reason that we do that is so that because it's participant directed, you ultimately choose how you want the money invested, and if you don't make a decision on your own, that's a good way to do it. Like you wouldn't want to go into the plan and be defaulted into that cash account, right? We talked about that isn't keeping pace with inflation. Years ago, that's what was the default option in 401k funds. It was a money market cash type option that really didn't have you invested in anything with earnings growth to get there. But the default is the target date fund, so it's a well-built portfolio that holds stocks and bonds with it. Any other questions? All right, we will shift gears now to the 10 reasons list. You should see that on the right-hand side. You don't have this slide in yours, but anybody remember David Letterman's show? So he always had the top 10 lists, so I have the slide up here. One, I think it's kind of funny, because this is Dave when he ran the show here, did it when he was from like 93 to 2015. Today, he's got this huge beard, and he has a show on Netflix where he interviews people, but he's definitely changed his lifestyle over the years a bit. But we kind of use this just the top 10 list of things to think about with retirement. So some people in the room may be closer to retirement than others, no matter what age you are. These are things to have in the back of your mind, concepts to evaluate. The earlier you start thinking about this, the better prepared you'll be when you get there. I get regular calls from folks that are retiring shortly, asking what they need to do with their 401k money, in a real panic about things. And the nice answer is, you're gonna see here, you don't have to do anything immediately. You got time, you can leave your money in the plan, you can do a rollover choice. There are other things you can figure out, but there are ways to get prepared for that ahead of time. So here are the 10 things that we're gonna talk about. Longevity, lifestyle, timing, income sources, post-employment option, Social Security, Medicare, medical expenses, long-term care, and then other factors. Some of these things we touched on a little bit. The reason you have it in a handout, and it's pretty laid out pretty easily, is so when you go back and look at this information, it'll ring a bell, hopefully, with what we've talked about. If you look at this and something doesn't make sense, that's the time to raise your hand and say, hey, I've got a question, I need to get in touch with that guy, Chris, and I'll be happy to help you. So longevity. People are living a long time. The average, 20+ years in retirement. Medical clients I work with are telling me that average is, you see it. So we've got that money, we're accumulating it. We talked about kind of that pot of income. We need it to last 20+ years. So it's a top concern. So when we talk about the target date funds, if you were in one of those are managed through that date, past it. So if I'm in a 2025 fund that's expecting I'm going to retire in 5 years, it's going to hold a lot of bonds today. It's going to be conservative, but it's going to manage about 20 years out past that date. It's going to stay invested in the market because I want to continue to get performance where I can. Lifestyle, I mentioned this a little bit with how much you save, but it is important. What do you want to do in retirement? Plan, think about it accordingly. You might do it now, and then a few years from now that might change. But the more you know about that, at least in general thought, it helps you to get sort of to the right amount of money for what you want to do. Timing. When do you plan to retire? Will it be at age 65? Some people want to retire earlier than that. Others, a lot of people that I meet with are working past age 65. I'm somebody that I had to have something to do. My goal is to hopefully, when I get to this time, to have some choice around what it is. Options, flexibility. And that's what I would love to see from everybody here, is some choice relative to a source of money that can help you when you're there. So what are you going to do? What do you want to do? When do you want to retire? Time frames. So you can go back to those tools we looked at where we put the years left and we saw how it impacted the money. You can move that around to see, based on goals, what it does for you projected. Income sources in retirement, company pension, 401k plans are there, Social Security benefits, any other retirement plans, or if you have land, outside investments, all that stuff. We kind of alluded to what you did with your question. Can I look holistically at my entire picture? That's what I want to do, to really project out what I'm going to be living on in retirement. Post-employment options, you can leave the money in the fund. You can take a lump sum distribution. Most folks don't do that. Why? Because if I take a lump sum distribution, I'm going to pay taxes on all that money in 1 year versus spreading out that tax liability. I can roll it into an IRA just like I could roll money into this plan. If I leave the company, I can roll money out into an IRA, an individual retirement account. If I go to work somewhere else, I can roll it into another 401k plan. When I do a rollover, it's a non-taxable event. I don't have any tax issues until I take receipt of that money. And remember, when we're talking about the tax implications, that's if I've done the pre-tax deferrals. If it's Roth, and I put it in, and it's been in the plan more than 5 years, and I'm over age 59 and a half, there's no taxes. I already paid it on that money. It's a tax-free withdrawal. You have the ability within this plan, or any IRA, or anything like that, to take periodic distributions, monthly, quarterly, annual amounts that you take out. Or you could purchase an insurance product, an annuity, something like that. Lots of options. One thing to know, if you are outside of a 401k plan, let's say that you've retired, or even if you're still working and you have like an IRA account separate from the company 401k plan, once you turn age 70 and a half, by April 1st of the next year, Uncle Sam is going to require you to take money out to pay taxes on it. It's called an RMD, required minimum distribution. Everybody is impacted by that at age 70 and a half. The only exemption to that is within a 401k plan. If you're a non-owner in a 401k plan, so I think that applies to all of us, and certainly, I don't own the bank, it really doesn't either, so it'd be for us. If you're still working, you do not have to start taking the required minimum distributions until you retire. So if you work to 73, you wouldn't have to start taking any money out until April 1st of the next year. But that's the only time when it comes into there are mandatory distributions out of plans. And I do see lots of people that work well into their 70s and continue to contribute to a plan, which is a great thing. It helps with that longevity. Social Security, we talked about this a little bit before, but try to get informed on that information. They used to mail us statements, and now it's pretty much online or an 800 number. You can go to the Social Security website. You can pull up information to see your specific benefits. Some of the tools and aggregators that are out there will give you an estimated amount, but this will get you your specific one. And there's good people there if you call and talk to somebody to ask questions. Social Security is a big piece of the puzzle. A lot of people start to take it early, like at age 62, and that's fine, but you get a reduced benefit if you do that. If you delay it to like age 67 or more, you get a little bit of an interest growth. When you start thinking about things with Social Security, it's important to address some questions that are probably not the most comfortable to think about, but kind of like, how long do your people in your family live, right? People live to their 80s or 90s, maybe you do delay it to have it more. If it's the trend has been earlier than that, maybe you take it early. Some things to think about. There's also some great calculators out there that can help you. Medicare. You want to be informed on the insurance options at retirement as well, the different parts of Medicare. Do you purchase a supplemental plan? There are professionals, there are people that focus specifically in Medicare that are experts in this. If you want to talk about Medicare with somebody, go to one of those folks that live and breathe in that world, because there's a lot of different avenues you can go down for this. With Medicare, a huge piece. You may be able to work with your employer to extend coverage as well too for a little while. Medical expenses, long-term care, insurance. By far the largest expense most of us will have in retirement. You can see that 70% over age 65 will need long-term care at some point. So factoring those things in. Just being aware of these topics are great. Other factors to consider: travel, hobbies, staying active, volunteering. My mother is retired, and she's become super active in Rotary. She was the Rotarian of the Year at her club a couple of years ago, which I thought was great. So she's gotten really civically involved. That may not be what your inclination is. Whatever it is, it's great. But think about those things. Put pen to paper and think about the things that you want to do. It all kind of builds. You know, if you think about a puzzle, you're putting pieces together to figure out what's right for you. How you should prepare, or how should you prepare? As I mentioned before, plan ahead, don't wait. Think about things to the extent possible. Periodically review that risk tolerance. Time to retirement affects how you should invest. We've seen the years of those things, the impact. Market fluctuation. We talked about the stock market moving up and down. Diversification, having well-diversified account in terms of stocks, bonds, holdings, and then take advantage of catch-up contributions if you're over 50. And you choose to. The deferral limit is 19, there's another 6. So if you wanted to be able to, in a position, put in more money, you're able to do that. What questions do you guys have for me?
I thought Social Security would change the projected retirement age.
The age, it's tied to your year of birth, so it has pushed out to 66 or 67. depending on
Mine's
your birthday.
70.
70. So some of them, they are adjusting that. Social Security is a system that's got some issues, right? I'm surprised at anybody. They will change it. They're going to have to make it sustainable. I believe that there will be a form of that still in existence. We've all paid into it. But you're right, the ages and things adjust. So that's why going to the site, getting your specific benefits, your age, all that. Because they've got it on a statement and form that you can get right off the website, or you can call them and they can talk it through.
What happens to 401k when you leave a specific company? Like if I leave First Piedmont to go work for whoever.
So you can leave your money in the plan if you choose to. If you have a very
Even if you're not
small-
making contributions, you don't have to.
Absolutely. Yeah, if you had a very small balance, They'll sometimes do force out to that, where if it's like less than $500 or $1,000 that is sent in check. Plans can do what's called mandatory rollovers, which they move you like between $1,000 and $5,000. If the account is moved to an IRA, it stays invested, it's just outside the plan. But you can leave the money in and then decide if you want to roll it over to another plan or not. A lot of folks, there are people that have retired from here who still have a balance in the plan that will call up Sherry or Donna and request a distribution from time to time. Yes, you can roll it over to another company where you work as well. And sometimes that makes a lot of sense. Remember my answer to your question about that. The rollover is a nice idea if you're getting company contributions, a match going in, because that really puts your account on steroids, if you will, in terms of how you're building that base. I have for you, if you want it, a list of the funds that are available in the plan. Anybody wants to see that? The other form is the deferral change form. We talked about this a couple of times. This is how you can increase that deferral rate. Your name and information at the top, you check the box saying I want to increase it, you sign and date it, and in July is when that impact would go into effect. Moving from 3 to 4, 4 to 5. My hope is you'll take a form, think about it, use one of these tools if you need to look at it a little bit further. If you say, you know what, I know I'm going to do it, fill it out now, sign it, I'll make sure it gets to Donna or Sherry or whomever, and then in July it will go into effect. This is the biggest impact you can have in terms of what projects to retirement. Putting in a little bit more, we saw things with that. Any other questions, guys? Thank you.
Thank you.
So I asked a few questions, I appreciate it, everybody stayed awake, that's great. I'm here for a couple minutes if anybody has an individual question. And then know that, my role, I'm here regularly meeting with the Retirement Plan Committee. Later this month, I'm going to Danville and a couple other offices. If there's ever a time where people have questions and we felt like that we needed to have individual sessions or something here, that's working through your team here. They'll get me on site. I'm happy to visit with you then. We'll pick up the phone and give me a call. All right. Thank you very much.
Thank you.